What's the relationship between an overdrawn director's loan account and dividends? Well, there's two sorts of relationship. The first one is by far the most common, which is essentially that a director may, due to the circumstances in which it's quite common for SME directors to run their companies in terms of draw money out of the company's bank account to live on, to pay personal bills, etc., put food on the table. And then when the accountant comes along or the financial advisor comes along at the end of the year to prepare the accounts, that the overdrawn director's loan account situation is essentially exposed. And at that point, it may be suggested that one way to address the overdrawn director's loan account is to declare a dividend, and that may essentially eradicate it and bring the director's loan account to nil or in credit. And that's one aspect of the relationship that's commonplace between a overdrawn director's loan account and declaring dividends. Now, the other is a slightly more complex issue, which is effectively when the overdrawn director's loan account is supporting the balance sheet, and that if the director is unable to repay the overdrawn director's loan account, and if the company is insufficiently profitable to declare sufficient level of dividends to essentially vote dividends to reduce the overdrawn director's loan account, then the risk may be that effectively the dividends that sometimes get declared could be unlawful dividends, and they would effectively be repayable. Now, on the face of it, it sometimes confuses people because on the one hand, the overdrawn director's loan account sits on the balance sheet and looks like an asset, but if it is irrecoverable because the director can't pay it, and if the company doesn't have sufficient distributable reserves, and if the company's prospects of future success is by no means certain that it is going to make sufficient profits to essentially reduce, to vote dividends to reduce the overdrawn director's loan account, then there is a very good argument to say that overdrawn director's loan account is really not actually a straightforward asset of the company, and that if it was essentially removed because of some sort of provision, that effectively the company would not have the reserves available to declare and vote dividends. And it's something that directors need to be aware of sometimes when they are tempted to declare dividends, when they have a balance sheet which effectively is really supported by its most material asset being the overdrawn director's loan account. There can be circumstances in which unlawful dividends can arise, and directors could potentially have to repay them in those kind of circumstances. It's all very well the balance sheet looking solvent on a numbers basis, but it also needs to be assessed on essentially a director's realistic basis in terms of are those assets really available to the company, because if they're not, there's a potential of what is considered to be a breach of duty and misfeasance in declaring dividends in those circumstances. It's definitely something that a director, before they do it, if they've got this kind of situation, because it is a little bit complicated, to take independent professional advice on. Questions, queries, concerns, give us a shout. We know Insolvency inside out.